Casey Carlson here. I practice in Bend, Central Oregon. So I get the pleasure of working with a lot of business owners who are approaching an exit. So my career has been 100% focused ever since college on business valuation and exit planning. I've got the opportunity to work in some specialties within that have prepared me well for the exit planning space. So I got to spend some time building out an M&A practice at an accounting firm on the Northeast. So that was helping people understand, okay, so what if I sold to an outside party? And then I also got to spend some time helping people think about, well, what if I sold to an ESOP? So I spent some time in an ESOP practice that we had. And then in several different chunks along the career journey so far, spent some time helping people think, well, what if I gifted to family members or sold to an inside party or one of the other many exit options that we get to explore in this. So had a lot of good opportunities to work with business owners like yourself. And fun fact, I spent 3 days of my life not being raised by a business owner, meaning that when I was 4 days old, my dad decided, hey, now's a great time to start a business. So, so that's my fun fact. I don't know why he chose day 4 of my life to do that, but that's how it shook out. David, how about we go back to you? Is there anything else that you want to share background wise, or should we jump
Yeah,
to Ray?
I think we can move forward
Good.
and just jump right into it. Thanks.
Julia, do you mind? Yeah, perfect.
All right. Well, welcome everyone. My name's Ray Madrano, right? Got some initials behind my name. Really, my career has been spent focused kind of similarly the way Casey has, right? Of business valuation. So I like to tell people that I focus on business valuation, merger acquisition, and exit planning. And that's kind of my perfect sandbox. Those three areas of practice really are the lens that I view everything through. I've had a lot of great experience just working with different size companies. And I think what makes me most excited about this type of work is getting to know the stories of people, right? Every company has an industry, yes, but how you choose to operate your business, what levers you choose to implement within your business, the type of firm culture that you push forward with is what's really exciting for me to get to know. And I love to work hand in hand with my clients. I feel like this work really lends to a lot of hand holding, right? We're working together. And a lot of it can be scary for a business owner for the first time, especially since a lot of it is brand new, right? Which is very understandable. Um, but just being able to come alongside and be that resource and provide that coaching is really what makes this so much fun for me. Outside of work, right? I love a ton of different things. But one of the things I'm really into right now is pizza baking. So I have a little bit of a pizza show off there in the upper right-hand corner because I got to control this slide. So that's the reality. All right, Julia, next slide. All right, so we're going to jump right into this, and we're going to start with the exit planning mindset. Okay, so let's start off with something a little bit jarring here. Most owners are not ready to talk about exit planning or even the concept of exiting their company at all. So it's one of those things where you're thinking, well, no, I'm ready. I'm totally ready. I'm always ready. I want to be ready. But the reality is there's a mindset that needs to happen. The mindset of I'm actually considering leaving my company and all that that entails versus the mindset of I'm actively running a company and growing it and developing it. And I like to consider this kind of the two opposing thoughts. One is a lifestyle versus a legacy type business. In a lifestyle business, I become the focal point of my business. I'm the touchstone, if you will. I'm in the middle of every decision. I'm telling people where to go, what to do. I'm orchestrating people. I'm moving things around. I'm the final person that signs off on everything. And that's fine if you want a lifestyle business. The problem with a lifestyle business is that it lacks transferability. And transferability is one of the most important factors that a buyer will look for when they're considering purchasing your business. Or if your plan is to not just sell, but just pass it on to someone else, maybe internally or employees, you still need that transferability. It still becomes very valuable and important. And without that, it makes it very difficult. So again, that mindset shift between a lifestyle business and a legacy style business, one that will outlast you, really matters. And that is kind of the first conversation that I like to have with people when it comes to exit planning. So, owner minded versus buyer minded, right? Same idea. As an owner, you're always thinking, well, how do I minimize my taxes because no one wants to pay tax? But the flip side of that is that a buyer really wants to buy a very profitable business. And so there is a little bit of juggling here that has to happen between the two thoughts. And we kind of work together to reconcile that, to kind of reposition your business and help you understand what these potential buyers are looking for, right? And most owners start too late. That's the reality. I think this is really important, right? That urgency is costly. I met with someone, I don't know, maybe about a couple weeks ago, and I had asked them, well, when do you want to be out of your business? And he kind of said it as a joke, but he said, next week. And the problem with that is that without time, preferably 3 to 5 years, we can't really plan, we can't structure, we can't really limit the taxes. We can't look at a lot of different ways that we can kind of maximize how much the person gets when they finally do step away from their company because everything is so rushed. Julia, next slide, please. So the other thing is the value gap, right? Most people have this really weird conception about what their business is worth versus what the market will pay. Perceived value versus market value, okay? Now, perceived value can come from a lot of places. It can come from revenue multiples. Oh, a good friend of mine named Google, right? Or maybe you ask an AI, what's my business worth, right? More common than not, I usually hear the friend story. Well, my friend sold for this amount of money. Well, my friend was given this multiple of earnings. Well, my friend who has a friend in that industry that's in another state sold for this. Therefore, this is what I should get, right? And we become very divorced from the idea of what our business is actually worth when we begin hearing everybody else and all the other voices. So really, when we start, I always recommend that we do a business valuation. A business valuation kind of sets the tone and it helps us understand the true value of the company. Often, if we're doing it for a sale purpose, I like to express it in a range, just so we could talk about where the company currently is and also talk about if there's ways for us to increase the value, right? Um, the sad truth is if someone comes to me and say, I want to sell next week or exit next week, we have no time. But if we have that 3 to 5 years, we begin strategically positioning and we can, in most situations, in most cases, increase the value of a company if we have enough time. So again, I can't stress that enough, how important that is. Julia, next slide, please. So why does valuation come first? Because it becomes the baseline of every decision, right? Without a good value for us, we don't really know if any of the other scenarios we're planning is feasible. We just don't know. Do we have an estate tax issue, right? What are the percentages we're gifting to people? What is the tax consequence of selling this company with this corporate structure? All of these things we need time to work through, and the business valuation helps us to have an actual number so we can actually give you, the business owner, reasonable, usable data and not just give you some abstract thoughts to consider. So really, the valuation is not a sales pitch, it's a planning tool. I like to think of it this way. I started working out a lot in the last year, and one of the things that my personal trainer wanted me to track was my blood work. And he's like, okay, you do the blood work when we start, and then in 6 months, we'll do blood work again. Another 6 months, we'll do blood work again, because it gives you a measurable third party point in time reference of what your metrics are before a professional starts working with you, right? So a business valuation is the same way. We need that first point of reference, and from that point, we can really start figuring out how to make it better. Julia, next slide. And Casey, it's all about you. Why owners misunderstand value.
Yeah, thank you, Ray. And I thought that was a really good point about starting with the valuation as well. One of the things that I always want to avoid as well is that surprise on the day that you go to sell when you
Mhm.
find out, oh shoot, this is not actually sufficient to fund what I wanted to do in retirement. Much better to find that out years before so we can make a plan to address that. So very good points. Thank you, Ray. So a few things that we're going to talk about here is just some mental models, some perspectives that we would advise against that could be some areas that cause business owners to get into trouble when we think about business valuation and exit planning. So the first one is focusing on revenue. So I worked with a couple business owners a few years ago. They owned a restaurant and they came to me and I asked them up front, what do you think this business is worth? And they said, well, we think it's worth a couple million bucks. We got to look at it. They made great food. They brought in lots of customers, and these customers turned into a lot of revenue. The problem is, at the end of the day, there was not a lot of profitability. So if you think about, well, we're going to sell this restaurant to somebody, they're going to take on a large loan to buy it, and then they're going to use the profits from the business to repay that loan. If there's no profitability to do that, it's just not feasible. There's just not value there. So I really like this quote. Ray did a great job putting these slides together, and I really like the quote that he added there. Revenue without margin is just activity. That's such a good statement. Very much something that we want people to focus on is let's talk about profit. The other thing is tax anchoring. So a lot of people, everybody should, as a business owner, I think it's in your best interest to minimize your taxable income. So on your tax return, what's reported there, there's not a lot of profit. And we're going to value your company as a function of profit. Should we look at the tax returns? Probably not. So we don't want your focus to be on that either. And then the friend that the Ray referenced of my buddy sold for 6 times profitability. Well, we hear that quite a bit. Almost always those numbers are going to be overstated. Couple reasons for that. Let's say that I completely lost my shorts when I sold my business. Just horrible multiple. You think I'm going to go brag to Ray about that? Absolutely not. So we are only going to be hearing the top end of those multiples. And then secondly, those there may be caveats in there that your buddy's not telling you about. They might say, I sold for 6x, but they only paid me 1/3 up front, and they said to get the other 2/3, you need to do X, Y, and Z. And perhaps X, Y, and Z never ended up happening. So we really don't think anchoring to what you heard on the street, what ChatGPT sold you, what Google told you, those really aren't useful data points. We're going to want to anchor you in actual data to make these important decisions. Any thoughts to add there, David Ray, Julia? All right. Do you mind hitting the next slide, Julia? Yeah, so to reiterate one of the points that Ray made, very important that we get time to adjust problems. So let's think about this. If we value your business and we say, you know what, we really don't think your leadership team is ready to take on responsibilities once you transition out of the company. Let's say that's our observation of what we found, and we say your company is not worth that much because of this factor. Once you leave, there really isn't the team isn't ready to support the company once you're gone. Unfortunately, if you tell us that and you say I want to be out next week, we say, well, I'm sorry to tell you, but you're leaving 2/3 of the value that's just going straight into the garbage can because that leaves with you, and 1/3 of that value actually gets sold. Versus if you tell us 5 years before this, we do the valuation and we take a look at your company and we say, we really think a lot of this value is associated with you rather than your leadership team. Then we have time to actually work with you to hire new people, build up capabilities, transfer customer relationships, that sorts of thing. So timing is really everything. All right, let's bump to the next slide here, Julia, unless David or Ray, you got any comments on that?
No, all good stuff, Casey.
Good, back to you, Ray.
All right, common valuation myths. Let's get into this. So, this is not meant to be exhaustive. And furthermore, we've got 12 of these, okay? So, I do not have the time in this presentation to do any of these justice, but I want to just show this as some highlights of common things that I've heard over my years of experience. I know things Casey has heard over his years of experience and just kind of address them in a kind of blunt fashion. So again, bear with me, right? We don't have enough time to really dig into these, but if you want to know more about any of these, feel free to contact any three of us, right? Me, Julia, or Casey. We're happy to talk through any of these concepts. So the first concept, right, is revenue is the value. Gosh, I have had so many people that said to me, well, I'm selling $10 million of profit, therefore my business is worth $10 million. And the problem with that concept is that you are thinking that revenue equals profitability. You are completely wiping out this concept of some people are really great operators and some people are really bad operators. And so that's why I always feel like just valuing on revenue isn't telling the whole story. So buyers pay for the cash flow. Remember, that's the top line idea in their brain. Nothing else. They want good cash flow. They want strong margins. So revenue does not equal value. Two, the last deal sets the price. This is where we look at deals that have happened in the market and say, well, hey, a business down the street just sold 3 months ago in my industry for 7 times earnings. Well, that's great. The problem with that is that time passes, things happen, interest rates increase, the sector changes happen. Maybe an industry is really hot for a moment, meaning that there are tons of people that are attracted and want to buy in that industry, and you've missed it by 3 months. That can happen very easily and very often when you're looking for a buyer. So, really, it's not a good metric to be using. I can sell at any time. Oh my gosh, this goes back to the idea that we just talked about, right? Where I said, hey, urgency is costly. Anytime you rush a company to a sale, you're going to attract these, what I like to call them, vulture buyers, right? They're looking for a good deal. They don't really care. They just want a good deal. They'll work it for a couple years, flip it, and make some money. They're basically house flippers, but with businesses. Okay. So stay away from that. I was meeting with somebody just, 3 months ago, right? And we were talking about that scenario. He got an offer of $600,000 on his business. And it was a small offer, but he reached out to me and said, hey, let's talk this through. So I spoke with him about this and said, well, you know what? How about this? Why don't you pay me, right? And I'll get involved and I'll just show up, right? And then I'll start negotiating in the background, but let me just show up and see how things change. Well, because I showed up and started negotiating, right? He's now getting ready to sign a deal for 1.2 million, which is really exciting for me because I love this type of work, right? Really exciting for me because I get to work with him and be involved in all this, but really exciting for him because all of a sudden he's figured out that, oh my gosh, like, yes, when we slow down the process, I can get more of what I want. My CPA told me what it's worth. This one's great, right? I'm a CPA. I have a lot of CPA friends, obviously. Um, Not every CPA is well versed in business valuation. It's a specialist mentality, right? It's like if I have a headache, I don't go to the vet. That's just how it is, right? I just don't do that. I mean, you could try to go to the vet, right? And the vet's like, well, here, take these aspirin. Yeah, but wouldn't you feel better about going to a professional that actually knew what was going on in the human body? That's kind of how business valuation is.
Yeah,
Buyers pay for potential. Sorry, Casey, did you want to say something?
oh, just I think probably everyone in the audience has resonated with number four at some point in that, we're specialists. You're a specialist in one area, I'm sure. And I'm
Mhm.
sure you've had that experience of someone coming in with an outside perspective of Chat GPT or my mechanic said that this is how you should build a house, that sort of thing. So I think we've all been there, but I would just encourage you. You don't have to work with us, although I think we'd be happy to, but whoever you work with for exit planning and valuations, they should that should not be their part-time hobby. That should be something that they have spent time to develop the expertise in.
Oh, it's so well said. I'm planning a wedding right now, and so we're interviewing photographers. And we met with somebody last night, and very sweet woman. She's like, I've been doing this for many years, and I'm exclusive. I only take on 10 clients per year. And so my fiance was very excited about this. And we meet with her, and I found out the reason she only takes on 10 clients per year is because she works at Walmart 30 hours a week.
Yeah,
So,
not the specialist.
not the specialist. Yeah. So buyers pay for potential. Well, no, buyers don't pay for potential. They want to see proven cash flow earnings. That's what's most important to them. Okay. Business value is unique and valuable. I mean, your business is unique and valuable, excuse me. Well, uniqueness is great. It's wonderful. However, if it's not documented, defensible, and if it doesn't add value, and here's the bigger deal, transferable, you're never going to be able to turn that into a dollar you can walk away with. Julia, next slide. I know the industry multiples. Oh my gosh, don't get me started on multiples. Okay, so I have a slide specifically devoted to multiples, and we're going to get to that. But basically, multiples are averages, okay? Just because you know your industry multiple does not mean your business is worth the multiple. And that's a very deceiving concept. My lease and equipment adds value. Well, it may, or it may very well hurt the value of your company. Here's the thing, if all your equipment is falling apart and you have it put together with duct tape, or you have one worker that's holding it together, true story, been there. That was his job to hold the conveyor belt. Um, that's not a good business. And someone doesn't want to take on how you've been doing it, right? Or if you have an unfavorable lease, they're not going to want to take that on. That just drags the value of your company down. We don't need a team to negotiate. This goes back to kind of what we already talked about. I will tell you this, an experienced CPA, an experienced advisor, experienced attorney will pay for themselves. Time and time and time again, they will. Higher asking price equals better outcome. That is the most deceptive thing ever, right? I have these people that have in their mindset, well, we're just going to ask for an insane amount of money. And if they agree, then I'm happy, right? Had a client years ago that wanted to sell his business for 10 million, did a valuation, it was worth 2.5 million. What do you want to do? Oh, we'll say it's for sale for 10. Okay. And they totally lost out. He's gone through 4 different buyers because he refuses to actually understand the reality of what his business is worth and also to not go out to market with such a huge number. All buyers are the same. This is not the truth. In fact, Casey has a phenomenal slide coming up here, and I'll let him talk more about that. But buyers have different motives, okay? So not all buyers are the same. And due diligence is just paperwork. No, due diligence is not just paperwork. It is a headache. It is where every number gets proven. And we have a team here that specializes in that because it is so arduous. So yes, be prepared. The right advisor will tell you. Next slide.
Yeah, and Ray, just on that
Yes.
point, I think I'm just talking to Brad earlier. But, it's very, it can be highly beneficial to do sell side due diligence work. So to have the due diligence done on the front end before going to market, to avoid retrading later, to avoid a lot of the headaches later with them coming back with
Yes.
the due diligence period itself takes much longer without it, without the due diligence, without the quality of earnings done on the front end. But very often it will if there are some unknowns that are discovered through due diligence, it encourages the buyer to come back and want to retrade later. So So to obviate all of that, it's better to do some due diligence or have a team involved with you on the front end before going to market.
Yes, so well said. Julia, next slide, please. All right, Casey, talk to us about normalizing adjustments.
Absolutely. Thank you, Ray. So actually, about an hour ago, I got a call from a person who were going to send an engagement letter to start a valuation project. And what he was mentioning to me, he said, "Hey, I've got this business. They do building material retail." And he said, this business has been going really well, and it funds a really nice lifestyle for me and my son and my family. But what you're not going to see a lot of is profitability on the bottom line." And I said, "You know what? That's not a problem. I've actually heard this story before. I've heard it just about every time that I talk with a business owner. They say that, we have lots of ways to reduce taxable income so that the EBITDA, earnings before interest, tax, depreciation, and amortization, based on the tax return, does not actually look that good. So what we do is we say, let's start with your actual reported EBITDA. Let's say that's 200,000 in this example here. And then we're going to say, we're going to make some adjustments for specific ways in which you benefit from your company that are expensed in and depressive to that reported income that we have. We're going to add those back and we're going to get you to 600,000 of actual EBITDA, normalized EBITDA. And let's think about the value difference there. If we have a multiple of 4 to 6 times, getting an additional 400,000 of profitability, that can translate to somewhere between 1.6 million and 2.4 million. So sizable impact on value there. And that goes back to the point around due diligence. What we're going to do on the valuation side is we're going to take a good look at your company and your expense profile and your history and your future and how you make your money and all that good stuff. And we're going to use that to say, okay, this is what your actual profitability should be. So that's the focus of due diligence. Every one of those dollars is going to pay for itself 4 to 6 times as you go to sell your company or more or maybe less. So that's why we want to spend that time to actually understand what the profitability of your company is. So there's a few different ways that we're going to look at due diligence adjustments. I think let's bounce to the next slide, Julia, and I'll show you some of those categories that we're going to actually look at. So the first one, if we think about owner compensation, so as the owner of a company, you get the liberty to set your compensation in a way that you wouldn't otherwise if you were an employee. So you could decide to yourself, hey, you know what? I like the sounds of $500,000. I'm going to pay myself $500,000 a year. Well, let's say that you could have paid yourself $100,000 a year. Right there, that $400,000 increase, that's going to suck up $400,000 of profitability. So what we want to do when we go to sell you or think about an exit, we want to say, let's put that $400,000 of profitability back into the company. So we're going to call that an add back. Another example, there's always personal expenses running through a business. You wouldn't even want to know what went through my dad's business, but that could be things like travel, meals, club membership, things like that. Family member expenses, maybe your kid's insurance actually goes through the business, even though they don't work there, things like that. So all of those things we're going to want to take a close look at. We're going to want to add those back as well. Same concept as above. Those are going to add to the profitability of the company, which is going to add to the value of your company. And then last kind of category to look at here. So when we think about historical profitability, what we really care about is what's going to happen in the future. So we look to the past and we say, well, the last few years we've made $1 million a year of EBITDA or 500,000 or whatever that number is. Well, as a buyer, I'd be interested in the past just to know, hey, you did this before. Well, I think it's reasonable that you could do it again. Now, if we think about, so we have this trajectory, what if there's a bump in that road? So say you had something very unusual, like let's say that you had a lawsuit, something that you don't think will ever happen again, just once in a lifetime fluke that really set you back in one of those years. Well, if we're just interested in the past as an indicator of the future, what we like to do is we like to add back the unusual events, strip them out, make it look like they never happened. So then we can say, well, you're not going to get sued every year, like in this example. So why don't we pull that out and then we have a smooth trajectory for where we think you're going to go in the future. So that's a few of the categories there. Ray and David, anything that you want to add as we think about adjustments to profitability?
No, I think that's well said, Casey. A little anecdotal story here, but I was working with someone that was a driller, water well driller years ago, and they went to a farm expo and they set up the drill because they were very proud. It was a very long, tall drill where they can go very deep into the ground to get groundwater. And the guy who did it set it up wrong, and it got breezy, and that drill toppled over and took out three or four vendors
Oh
and their
no.
trucks. Well, that is a prime example of these non-recurring one-off expenses.
Yeah.
It was painful. It was very painful. And then, of course, the lawsuit that ensued.
Yeah, that's a great example. So all of those things, you're gonna hope that every year you're not gonna have a repeat where your well drilling rig falls over at an expo and crushes a family of seven or whatnot. We're gonna assume that was a one-time event, and so we're gonna strip that out. So next year you're not gonna have that. So why don't we pull it out of the past as well? So thank you, Ray. All right, Julia, next slide, please. All right, I'll kick it back over to Ray.
Okay, multiples and cash flow. All right, how multiples actually work. Multiples, I want you to think of multiples mean average. Okay. And I like to tell people when you're considering multiples, when you talk to your friend, when you talk to ChatGPT, when you talk to any other AI, when you hear stories, when you've Googled this and you look up multiples for my business, because we've all been there in honesty, right? I've done it several times for accounting just because I'm curious. Um, Multiples are averages. So I like to ask people, is your business average or are you better than average? Because if you're better than average, then a multiple doesn't necessarily capture that. And a business valuation will, right? Now, consequently, if your business is horrible, no judgment, right? Um, and there's a multiple, hey, and someone's willing to pay you that multiple, hope that they don't know what they're doing and go forward. But you didn't hear that from me. So, but that's a multiple. Multiples are averages, okay? Now, what actually provides value for your company is again, we're talking about cash flows. Two businesses with identical EBITDA will trade at different multiples for a host of reasons. Okay, but most of these reasons have everything to do with whether that company was set up as a lifestyle business or a legacy business. Is this business completely dependent upon you? Or is this business transferable? Will it outlive you? Now, the last point here, 5x on 500,000 of proven income, proven earnings, beats 7x on inflated numbers. Here's the reality, and it goes back to the due diligence process that we kind of talked about here, right? With the quality of earnings. If your numbers are so messed up and we use those messed up numbers and apply a really good multiple to it, you're going to get a number in your head like my business is worth 20 million. And the reality is those numbers were so messed up that what we had to start with isn't even true. And after we had to adjust it, we realized the business isn't worth 20 million. It's actually worth this amount, right? So the concept here is really we need to spend the time to understand the cash flow, like Casey was talking about. If we understand the cash flow of the company and we have done all these adjustments, then we move on to the next point of multiples. But a multiple, again, is just an average, and it's only good when used against solid numbers that have been proven. Next slide, please, Julia.
Anecdotally, Ray, it's like
Yes.
stretching the truth on a dating app. So you might say I'm 6'2" and chiseled on a dating app, and then
Yeah.
you show up in reality and they say, I don't know, you don't look like you're 6'2". That's gonna be a problem.
Well said. Very well said. And I like that anecdote. Very memorable. So what moves that multiple up and down, right? There are a few things here, right? What decreases it? Well, owner dependency. Again, this is that lifestyle concept that I'm talking about. Customer concentration, right? If you only have five customers and most of your income comes from three of those customers, you have a concentration issue. It's crazy. No management depth. Maybe you have no management. Maybe you don't just even have the depth, you just have no management, right? Declining revenues, industry trends, right? That's a big deal. Having a bunch of older equipment that maybe needs to be in fixed or rather replaced, right? Because you've been fixing it every year and the duct tape only holds so long. Those type of things really do drag down the multiple. Now, factors that actually increase the multiple, reoccurring revenues, diversified customers, strong management team, having documented policies and procedures of how you do things, right? If you are built like a machine, that is a great thing because revenues are just turning over. They're just moving through the machine, and that's a wonderful thing. Now, reoccurring revenues is probably one of the strongest ways to move your needle up. Businesses with subscriptions, contracts, retainer revenue, right, will sell for higher multiples. Um, Years ago, I valued a trash company, and I was genuinely surprised, right? This company had 10-year contracts with all the municipalities in the area. 10-year contracts with guaranteed increases tied to inflation and guaranteed increases tied to profitability raises, right? It was outstanding. It was one of those companies where I stared at it and I'm like, this is probably one of the most stable companies I've ever seen. And again, it sold for a higher multiple because of that stability. Next slide, Julia.
Wow. Ray, if I could riff off that point just for a
Yeah,
moment. One of
please.
the foundational IRS guidance that's out there for industry is revenue ruling 5960. And so that there's a statement in there that I really like. They say that business valuation is essentially a prophecy as to the future. And sometimes that's what it feels like. We joke about having a crystal ball that you have to look into to see what's going to happen next. And we actually bought my former boss a crystal ball for exactly that reason for Christmas. I bring that up because when you think about recurring revenue, that eliminates the need for the crystal ball, that eliminates the need for the prophecy, that eliminates the need for the guesswork, because you can say, actually, I know that I'm going to have at least X amount of revenue because I have a contract right here that's signed that says that I'm going to get that.
Exactly.
All right, so we're going to talk about knowing your buyer here. So we're going to run through several different types of buyers. The first one is going to be a synergistic buyer. This is probably, when you think about selling your company, this is probably the one that comes to mind of, you know what, I'll just sell to a competitor. A lot of great upside to that often works out pretty well for people. You could also consider selling to a supplier, selling to a customer. So it's someone that's adjacent to your space, just so that you can capture some of the synergies that are available there. So that's what's really gonna drive the sale to one of these parties is thinking about, well, how can we capture on the idea that 1 plus 1 is sometimes equal to 3 instead of equal to 2. One of the things that we're going to want to really focus on there is integration risk, especially as you think about from the buyer's perspective. That's something that we're going to want to minimize and be aware of as we think about how do these two different puzzle pieces fit together. All right, do you mind jumping to the next one, please, Julia? The other concept is financial buyers. So you can think of financial buyers as if I bought a business from Ray when neither of us were we weren't in the same industry. Ray creates pizza, I don't create pizza. I want to buy Ray's pizza business, so I make him an offer. The focus here is really going to be about the quality of the company. I like to think about there's a scene from The Office, if any of you have watched The Office before, and Michael Scott, good. He's a person that loves and cares about his employees and whatnot. And he's negotiating with an employee, Stanley, who is considering leaving. And Michael says, Stanley, how can I get you to stay? Stanley says, just flatlines, money, more money. That's what I want. That's what I tend to think about here. So what we're thinking about for financial buyers is I want to buy Ray's Pizza Shop if it's producing stable profits that I can then use to repay any loans that I might have used or generate a return, that sort of thing. Generally focus on the what we got there is what they care about most, EBITDA quality, exactly that. So you need to be able to prove that you have a future profitability for your company. As compared to if you sell to a synergistic buyer, that might not be the case. I presented valuation findings to a lady yesterday, or maybe it was Monday. Um, and we showed her, we said, if you sell to, she was in the great position to be in where she said, I want to exit, and I can either sell to a financial buyer, which is two people that decided they wanted to get into her business, made her an offer, or I can sell to an outside party that's a synergistic party. We took a look at it and we said, unfortunately, you really don't create the profitability that would attract a financial buyer and allow them to repay outside investment, that sort of thing. So we really recommend that you sell to the synergistic buyer because your cost structure is not as relevant to these people. And frankly, the cost structure of this company was not that great. A couple other things you might want to be aware of is the structure of the deal. So there might be things like earnouts, which is to say if you hit these targets, you're going to get this portion of the deal at a later date. Or equity rollover, where they say we're going to buy you, but a certain portion of that is going to be paid in the stock of a new company. All right, that's what I got of financial buyers. Ray and David, please chime in if any additional thoughts on that. But Julia, if you could bounce me to the next slide, please. All right, employee stock ownership plans or ESOPs. You might have heard of these as employee-owned companies. Some employee-owned companies are ESOPs. Not all employee-owned companies are ESOPs. But what these are is a qualified retirement that's set up on behalf of the employees. People often think, well, if I form a ESOP, am I just giving away the company? Well, actually, you're not. And the reason is that the government sees this as a very beneficial way to grow the economy, and they've intentionally created some tax incentives to make this possible. So what happens if you decide, usually 70% of the time people structure as an S Corp ESOP, which is slightly different than a C Corp ESOP. But let's just say you're in the 70% and you decide, I'm going to become an ESOP. And what you actually do is you sell, not give away, you sell your company to a trust. This trust owns the shares of the company on behalf of the employees and is actually set up as a qualified retirement plan. That trust does not actually have to pay taxes. So what happens is every year, as the company makes money, they pay down a loan that the trusts use to buy the company from you. So the short answer or the short version of how an ESOP works is that your company becomes, uh, they don't have to pay taxes going forward if they're structured as an S Corp, and those tax savings are instead used to buy the company from you. Few things to consider if you do decide to become an ESOP. One is there's definitely professional fees that are associated with this that are not as represented in other exit options. So you're going to have annual professional fees for things like trustees, plan administration, outside valuations, things like that. And those can be costly. So you want to be of a size that you can capture the economies of scale that really make an ESOP work pretty well. Another thing is that the government has said we want to incentivize this in order to help grow the economy, but what we don't want is people taking advantage of this plan to get rich by overselling something to their employees. So this is governed by ERISA, and they will be very quick to say this transaction was not at fair market value, and there's going to be a lawsuit to unwind this transaction. So we want to be sure that we're selling at fair market value, which means that when you're reaching to the synergistic buyer, the competitor, and saying you're going to have to pay the sun, moon, and stars for my business, that's not really a luxury that you're going to have with an ESOP. So a few things to think about there. For the sake of time, Julia, if you could bounce me to the next slide. Management buyout. The benefits here are that you're selling to a known buyer. You can continue your culture for your company. The biggest problem there is right in the middle of the slide. Financing is a central challenge. So if you If your employees had a bunch of money to buy your company, they probably wouldn't be your employees. They'd probably be off doing something else. So that's how I like to think about this is they probably don't have the money to pay you out. So you're probably going to have to lend them the money or work with a bank to lend some of the money. One way or another, financing is going to be a challenge, but this does have the benefit of right there on the bottom, high deal certainty. So this is probably going to work if you talk with your employees and they say I'm interested in buying and you say I'm interested in selling and you're generally aligned on price, you can probably make the financing work somehow, but you might have to drop the price a little bit to make it work. Next slide, please, Julia. All right, last strategy, and these are in descending order in terms of how lucrative they are, just FYI. So the least lucrative is probably going to be family gifting. So this would be the idea that you want to transfer to your family. There's a lot of great ways that we can help make this a tax efficient transfer. So that's one of the benefits of this. But kind of the trade-off there is that this isn't a liquidity event for you. This is you just handing over the keys to the business. So lots of good options. All of this to say that who you sell to matters, and there's different characteristics of a company that would align it with one of these different parties. And also, last point on this is that if we talk with you early, we can help you understand which one of these exit paths makes the most sense for you and help you in the next 3 to 5 years to plan for that transition because your next 3 to 5 years is going to look different depending on which one of these exits you choose. Back to you, Ray.
Yeah, well said, Casey. All
Thank you.
right. Let's go ahead and kind of rush through these last two slides real quick here. So phases of exit readiness, right? I like to think of things in kind of three phases. It's simplistic and easy, and I can count to three, right? The first step is baseline valuation and gap analysis, right? Hey, what do you think your value is? But what is the actual value of the company? And let's get some sobering thoughts. And from that point, let's begin planning. Phase two is enhancement. I like to think of this as the makeup phase, right? Because at this point, I want to take your business, and because of all the information I accumulated through business valuation, I can now say, hey, listen, these are the things you need to improve upon. These are the ways you need to change how you operate your company because these are the factors that are actually decreasing the value of your company. And if we can get rid of these or mitigate these in some way, we'll just increase the value. Okay. And once we finish that, we go to market, right? Let's figure that out. What does that look like? Hey, which one of these buyers resonates most with you, right? I've done a lot of management buyouts recently, because that's the flavor of the month, it seems like. But any of those buyers are applicable. Now, within that, we're going to suggest that you build a SIM, which is a confidential information memorandum. And it's basically a marketing piece that reflects the business. It gives a highlight of financial, but also provides a narrative about the company and what makes your business special. The bigger the company and the bigger the buyer you're trying to attract, the better the SIM needs to be. And we prepare that in-house, right? We identify and approach buyers on your behalf. We'll manage the letter of intent, right? The letter of intent, if you don't know, is just a letter that comes to you that is kind of like the roadmap of key financial negotiating points of a deal. Okay, so it specifically spells out all of these big ticket items, if you're doing this correctly, that need to be identified up front as you get ready to sell your company so that there aren't surprises later on. Next slide, Julia, please. So what does a well-run exit look like? Honestly, it is your deal, your way, your terms, your timing. And we can do that if we have the time. If we don't have the time, it's hard. Mistakes are always made in haste. Okay. If there's one thing I want you to remember from this webinar, it's this. Don't try to do this alone. There are lots of professionals out there that will help you. I know Casey and I, David, we would love to be a part of your story and help you finish your race, so to speak. But really, I'll leave you with this last thought, which hit me last night at 10:30 last night when I was looking at these slides. From concept to closing, the advisory team at Sorren has you covered. All right, next slide. So thank you all so much. We do have a hyperlink here, right? If you are interested in taking our exit planning survey, it actually kind of hits on a number of points that we have talked about here, and will kind of give you a usable metric for yourself. It gives you a grade, based upon what we would look at. Now, it's not complete in that it's not exhaustive, right? And really, what we would love to do is you take the survey, one of us would meet with you, and we can talk it through and kind of explain it. But this is a quick little way and quick little something that you can do to kind of get more familiar and kind of have a sobering thought for yourself.
And Julia will include a link to that in the follow-up that goes out as well.
Perfect. Well, I know we're right up against the hour, but if anybody has any questions, right, we'd love to take those questions. And if you have any sensitive questions, feel free to email us. Our contact information is right below. And we'd love to just talk to you. So, yeah.
Doesn't look like we have any submitted questions yet, so we might be able to get one quick question in if someone has a burning desire to get something answered. Otherwise, thank you so much, Casey and Ray and David.
Yeah, of course. Well, we'll be around. Please, if you do have any questions that come up later, you've got our contact info there. So thank you all.
Yeah.
Perfect. Thank you to everyone who joined us today. We'll send a follow-up email with the recording and the link and some additional resources. If you have any further questions, feel free to reach out with our contact information here. Otherwise, have a great rest of your day, and thanks for attending the Sorren Exit Planning webinar.
Thank you all.
Thank you
All right,
very
take care
much.
all. Thank you.
Thank you.